Hey, good morning, everybody. It's Hammer. Today is Thursday, August 29th, 2024. I, of course, am with Originator Success here with your daily mortgage rate update, the only place on the web where you guys get to join me live each and every weekday morning, 9:30 a.m. Eastern Time. If you're here this morning, say good morning. If you're watching on the replay, don't forget to give me a hashtag replay. That's hashtag replay in the comments, whether you're on Facebook or on YouTube. I appreciate that. Remember, don't forget to smash that like button, tag an LO friend, share us in a group. If you're on Facebook, do the thumbs up. Make sure you comment. It helps the algorithm. If you're on YouTube, please go ahead and there's a little thumbs up you can give on the video. Make sure you subscribe. Make sure you give a comment on there, the hashtag replay, or say good morning. Again, that helps us with all of the social media algorithms. So if this is your first time here, I do this each and every weekday morning at 9:30 a.m. Eastern Time. If you'd like to sign up for a reminder that I'm going live, if you'd like to be notified, it's a free text. Nothing, no cost to you, hmmr.io/reminder, or use this cool QR code that we've got over here. You can also get a lock advice email at www.ratelockadvice.com. Doesn't look like it's putting the little code that it used to put for the Restream ones. I wonder why. Also, if you would like to sign up for our rate text alerts, they're www.ratetextalerts.com. That's an email to or text message a couple times a day, letting you know what's going on with the markets. Last but not least, although I love talking about rates and pricing every day, at Originator Success, our elite membership and platform is there to help you with the tools you need for a few $100 a month to go out and get business. We get you loans from Google and social media. We do that by dialing in, optimizing, and really, supercharging your online presence, your social profiles, Google business profile. We set everything up. If you don't have it, we help you get them all dialed in. We keep them running. So you'll be found on Google. People get loans from Google because they are found, and that's where people are going as rates are going to go lower. Man, I'll tell you, we got mosquitoes around here. I normally don't. I keep killing them when I see them. Anyway, check us out at originatorssuccess.com. Enough about that. Let's say hi to the live folks here this morning. Which of my friends are all here. Glad to have you. Appreciate all of you show up each and every day. James Mahan over there on the YouTubes. Good morning, sir. Mike Tebow, great to see you, sir. Ron Siegel said today is Chop Suey Day. I don't even know what Chop Suey is, but it sounds racist. I'm just kidding you. Michael Love, good morning. Bobby Searson, great to see you there. Yes, Mark, I will talk about that a little for you. Bobby Searson, Yasmin Martin, Mark Clark, Mike Morano, Kim Mason, Megan Lindberg. Good morning, all. Rob Stewart, Sean Segaloff. I'm gonna get this thing, man. I'm telling you, I'm gonna get it. Or I think I have gotten it. It might be his cousin. Anyway, Rob Stewart. I missed it that time. I'm going one-handed. It is a mosquito. All right. Anyway, Teresa Jones, haven't seen you in a while. Hi, Teresa. Ron Segaloff or Sean Segaloff, Deb Dickinson, good morning. Mark said, can you speak more to the potential Fed rate cut already baked into everyone's pricing? Meaning, do you expect rates to decrease, stay the same, or increase based on the Fed? That's a great question, Mark. And, I will absolutely dig deep on that one because I see a lot of misinformation on Facebook. LOs just don't understand what's going on. So I'll go through the other stuff and then I'll come back to this. So for those of you that want to dig deep on what's going on with rates longer term, I will absolutely answer Mark's question. Amy Blaser, good morning. Adam Cars, good morning, sir. Kenny Rivard, good morning. Great to have you here. All right, y'all. So what do we got going on this morning? First things first, let's just do a quick recap of what happened yesterday. If we take a look here at bonds, we will see that right down here, we had a bit of a downward trend. See this right here? We kind of can't, you guys aren't seeing it because that's not, there it is. So right up here, this is yesterday, everything in front of this little dotted line right here and between this dotted line right here, this little section, that was yesterday on a line chart. And when it goes down, when mortgage bond pricing goes down, the price that traders are paying for mortgage bonds, that means rates get a little bit worse. Pricing gets a little bit worse. When it goes up, like we saw here the day before, things get better. So what happened was on Tuesday, we were getting better. See that? It came up. And then on Wednesday, yesterday, it kind of came down a little bit. Nothing to worry about, though. Really not even a little bit at all. Yesterday, bonds lost a bit of ground through the day. Nothing to worry about. It was really just a little what I call bond drift. And that's normal, right? And, when you see that. But rates, we had this little peak right here. So rate sheets actually were some of the best rates that we had seen on the day, on the week, 6.37 using Mortgage News Daily as a reference point. Today, we're going to see things a little bit worse. Rate sheets today are slightly worse. Not much. It's going to be more like what we saw on Tuesday, you know, before we saw a little bit of improvement yesterday. So it's going to be more like this, but really not a big deal. Not much that we have to worry about. A reprice risk on the day is low. This morning we have this morning brought in the final second quarter GDP numbers. They came in a little bit higher than expected, 3.0 versus 2.8. That just shows a strong economy, and a strong economy does not really designate that we need Fed rate cuts. And that's why you see small reaction in bonds to that, and why they're off to a little bit of a weak start this morning, as well as the jobless claims that came in right as expected. And remember, anything to do with unemployment, with the labor market getting a lot of attention now, because that's what the Fed has basically turned their spotlight to, right? I know that this is actually butane for my lighters, for my cigars, but pretend it's a flashlight. That is what the Fed has shown their flashlight on now. They are looking at labor market data. So anything that we see like that there. But as far as the outlook, rates are looking like they're going to end the week slightly better heading into the holiday weekend. Tomorrow, we're going to get the PCE inflation data. That data is not likely to be anything that we have to worry about. I don't think we're going to see a huge improvement tomorrow, but I think we're going to end the week on a good note. Remember, we got a few different things going on. Number one, it's the last trading day of the month. That's going to have some effect and have a little bit of movement in markets. We're going to have the PCE inflation data, and it's basically the last hoorah for Wall Street. It's the last Friday of the summer. Before Labor Day weekend. It is a 3-day weekend, holiday weekend. Traders are going to come in. They're going to set trades based on that PC inflation data, making a couple of things. Generally, you're going to see some money parked in bonds over the weekend because it is a long weekend. You're not going to see huge improvements to rate sheets tomorrow, but we'll probably end the week with, better rates even than we saw yesterday. I think we'll see a little bit of improvement. So because of that, that puts me in a position where I absolutely would be cautiously floating everything into tomorrow. I don't think there's a reason really to float tomorrow. I've been saying in my other advice, there's no urgency to lock, but no real big incentive to float. I think today is very much that same way. I don't have an urgency to lock anything. Especially going into the holiday weekend. Next week, we've got more to work with. We're going to have the JOLTS data, ADP data, another jobless claims. Then we get into the big BLS jobs data. Next week's going to be the big week. Remember, when we saw that last time around, right here, this move right here, this big anomaly, this big thing, you could see, I showed this the other day. It's a nice steady trend improving where rates have improved very steadily. And then we had that big jump right here. We had a huge overreaction to the labor data. We also had a reaction to the Fed meeting right before that. So the Fed meeting was right here. The labor market data was right here. We saw way too much of an improvement. It kind of corrected itself and we're back on track improving. Now let's go back to Mark's question and let's talk about this here. So here's the deal, right? First of all, remember, as much as you want to be educating consumers and even agents, at the same time, you got to write loans. You got to get business. You don't do that by arguing with people and telling them they're wrong about stuff. But so you don't have to go out of your way to explain to them that they're wrong on these, because by being wrong, they're actually still going to be right. A lot of times, here's what's happening. People say, I'm going to wait until the September Fed meeting in the middle of September, the 18th. I'm going to wait until the Fed cuts rates because mortgage rates will fall. Now, when we take a look here and we look at what's going on, and let me put Mark's question back up rather than that. Okay. So when we look here at Fed futures, we can see that markets are currently pricing in the idea that we're going to have one Fed rate cut for a quarter point in September, right? So there are the outlier that we will get to a half a point. The first week of September, if we get another weak labor report, we will see this change. Okay, so I'm going to take this off of the way for now, but we'll come back to that. So if we get a weak labor report next Friday, a week from tomorrow, if it's really weak like the July data was in our August reading, this is the August data in September, we will see the expectation of a half a point cut jump again. Now, this is what markets are currently pricing in, and it's why we've seen mortgage rates improve. I mean, at the beginning of the month, at the end of July, we were at 6 and 7/8, and we were above 7%. Then we got into where here it is, the Fed meeting, and then we've gotten the labor market data was on the second, and look at this drop. 6.34 is where we fell down to. Now, we were yesterday at 6.37. We were right back there at this wonderful spot, right? But in the meantime, we kind of lost some ground here. And again, that is very much in correlation. You can see it. Let me refresh this so I can. Won't let me slide over. Morning, Alan Christian, Superstar, Tanya. Good morning, Zell, Rayleigh, Steve Lacefield, Kenny Rivard. Let me know if you guys are following along. By the way, so this was the best pricing that we saw. Right when we saw all this improvement that Monday, boom, things were fantastic. Then they kind of slid down. You notice that we're back up to those same levels. We're back up here. That's why you see that same correlation where we jumped up to this wonderful levels here. And then it took us all month. We lost a little bit of ground and then it came back. And that's exactly what you see happening here with mortgage bonds and mortgage-backed securities. So that's your direct correlation, Mark, that you see happening. Now, as far as it goes with the Fed and being priced in, yes, markets have already priced this in. The idea by the end of the month that we're going to see a full 1 point in rate cuts. I don't know how they think that's going to necessarily break down, whether that's going to be, right here, you can see that it's really an expectation of possibly a 0.5 point cut in November, but this would be another 1/4 point cut. So it's kind of a coin flip there. And then there's that expectation that they're going to have to be more aggressive. Now, when you look at this, what happens is you've got to be looking all the way, at these future meetings. You've got January of next year, March, May, June, right? And where is the Fed's neutral Fed funds rate? Neutral means where is that Fed funds rate sit where the economy is doing well, but we're keeping inflation at or around 2%. The labor market is doing well. And markets believe that that's going to be around 3.25, maybe 3.5 as we get into next year. And as we get to the end of next year, markets believe that that'll be at about 3%. Notice that it doesn't go much lower than that, right? It's about 3% is where markets currently say that should be where we think the Fed funds rate should be in order to keep things flowing in a very neutral state, in an equilibrium, if you will. Now, taking a look here, when we get to this Fed meeting next month, the Fed is going to point out that they're going to make comments about the labor market. We're going to have that September 6th labor market BLS report in our grasp as well. And there's room for rates to continue to improve. So the improvement that we've seen already is based on the expectation of what is going to happen. Like what Mark pointed out, it's already been baked into the pricing. Okay, right now, baked into the pricing is the idea that we're going to get a 1/4 point cut in September, that we're going to get another cut in November, maybe even a 0.5 point cut. You'll see it right here. And then in December, that we're going to end the year with, there's about a 30%, about a third, believe will be at 3/4 point cuts. A little, almost half think will be at a full 1 point. So somewhere a 0.5 point gets cut in there. And then 22% believe that will be more than that, that will be cutting bigger by then. Okay. Now, as we get into these months, as we get into November and December, when the momentum is building that the Fed is going to need to cut, that's going to leave room for rates to come down. So that's going to falsely confirm expectations by consumers and agents and anyone else that, hey, when the Fed cut rates in September, mortgage rates improved. They didn't improve because of the September Fed rate cut. They're going to improve because of expectations of what's going to come after that. Does it really matter much? Not really. The idea is you want to be putting across to your consumer that rates are likely to continue to edge lower, but that it's not going to happen quickly. They're not going to go nearly as low as we've seen in the pandemic, and that they want to take advantage of savings now because we don't know how long it's going to take for rates to move lower. It might be 12 months from now. It might be 18 months from now. It might only be 6 months from now. We don't know. And people can profess to know, but remember, the Fed is going to react based on the labor data. If labor data shows a lot of weakness, if inflation continues to go down, we will see rate cuts happen faster. Rates will drop faster, including mortgage rates. But if that doesn't happen, it's going to draw out farther. That's why we ended up in 2024. If you remember, if we were to go all the way back to, let me move this to 6 months, and I don't even know if that's far enough here. Let me change screens. Come on. Oh, hold on. Let me do this. Let me do this. Okay. So if we go back, I'm going to go back to a year. All right. Take a look. Remember, when we were in December and January, look at where we were, right? And we've returned to that. We're back to that. In fact, we kind of picked up where we left off. But in December, we thought rates were going to be getting better. Look at this big increase in how mortgage-backed securities were selling. They increased in value. Remember, this is good for rates. When we see a trend going up, that's good for mortgage rates. Well, what happened at the beginning of the year is they went back down. Why did they go back down? Why did mortgage rates creep back higher? Because of the expectation of inflation not moving and the Fed saying we're going to need to stay higher for longer. And we have drawn out all the way through August. We thought we were going to see the Fed start cutting here, and it didn't happen, and they lost ground. Then we started to see inflation improve again. We started to see signs that the labor market is weakening here, and boom, now we're back up again. And that's what's going to happen is, depending on that data, we could level back down. We could go up. It's all going to depend on how that data comes in and all that stuff. So hopefully that helps you. The bottom line, if I were to reiterate this one more time for you, and I hear you, Ron, that joke never gets old. Ron said, did I say the BLS report or the BS report? We know it's the BS report, but it is what we've got to work with, right? So remember, if I were to kind of just summarize this for you, yes, mortgage rates have already improved from a month ago, from 6 weeks ago, based on the idea that the Fed is going to start cutting rates in September. That has already happened. It's why we're seeing it. However, once we see that first rate cut in September, we get more jobs data. That will open the door for mortgage rates to move even lower, based on what's going to happen in the future. So it's going to feel like it was a reaction to the September data, when in reality, it is a pre-action, right? A pre-action to what's happening. I don't even know if that's a word, pre-action. If it's not, I think it should be. So it's not going to be a true reaction. We're going to call it a pre-action to what is happening after that September date as we get into November and December. But it's going to feel like people were like, see, I told you when the Fed cut rates, mortgage rates would go lower. All right. So hopefully that helped you, my man. Let me know, Mark, if that helps you. Anyone else, let me know if that helped you. John Melnick, I'm still rambling, dude. You're not on the replay. Jerry Avila, good morning, sir. Let me know, y'all, if that was helpful for you. I can also give you a way to put that into kind of a different language for consumers if y'all want. Mario said, hashtag pre-action. That's right, my friend. Yeah, and that's really, you know what, we're going to coin that word. I'm going to use that word a lot more, pre-action, because that's what it is. It's a pre-action. Ron Siegel said, when rate cuts begin, as Powell indicated, the market will stabilize, servicing premiums will return. This also narrow the spread between the 10-year and the 30-year mortgage rate back to the historic norm of 1.79. All true, Ron. I don't talk enough about that. I don't even know where to look at that to see what the spread is on the difference. I don't know where to grab that chart. I'll have to look. But Ron is absolutely correct on all this, y'all. Also, the 2-year and 10-year yield inversion, that signaled the recession that we never truly had, but yet kind of did a little. I mean, if you talk to anybody, they're going to tell you, yeah, things are getting tough. Also, the reason we didn't go into a deep recession and the reason the Fed rate hikes did not work the way they were intended was because people were spending credit. People were spending money they didn't have, and the government continued to give us money in many, many forms, through business, through personal, through student loans, being pushed off and some paid off and all that stuff. So anyway, my friends, thank you very much. Glad to have you here. Hope that helped. Tomorrow, I'm going to be coming to you from the airport. I'll probably do it on my phone. It's going to be short, but I do want to get that out there for you. We're going to talk about what happened with the PCE inflation data. I may be a few minutes late, depending, but I don't think so. But anyway, I will be coming to you tomorrow, but I'll be coming from the airport. So just aware of that and be ready. Good morning, Kyung from LA. Pre-act to get that info to our clients. If there's a cut, we should see a positive reaction. Yes, exactly. And it's not just the cut though. It's going to be more on what happens in the press conference and what Powell says, because everyone is always looking for what comes next. The expectation of a cut's already there. Markets have priced it in. I think it'll be a quarter point unless we get really weak jobs data again on the 6th. And as we head into that, that's where we're going to, it's going to open up the door for rates to drop between now and that next Fed meeting in the first 2 weeks of September. And that's why we are absolutely cautiously floating right now. And I say cautiously because we aren't with reckless abandon, but we want to be aware, we want to be careful, but things are very stable right now, putting us in a position that we're floating. So we call it cautiously. Giddy up, Mr. Randy Tico. Great to see you, sir. And you think Mortgage News Daily has that chart? I'll have to look. All right, my friends, I'm going to wrap it up. You guys have a fantastic day. I'll see you tomorrow. Bye-bye.